The silver market didn't scream when it broke past $67. It didn't explode. There was no panic button, no emergency broadcast, no red banner scrolling across financial television. And that silence is the most dangerous part. Because markets only stay quiet when something is being carefully managed, or when something is already out of control. For decades, silver has been treated like a background metal. Gold gets the headlines, oil moves nations, stocks dominate screens. Silver was supposed to stay obedient, industrial, predictable, contained. But now it isn't, and when silver stops behaving, it never does so politely. The move to $67 wasn't just a price increase, it was a signal, not to the public, but to institutions that understand what silver really represents inside the global financial system. Because silver is not just a commodity, it's a pressure point. And pressure points don't break loudly. They collapse silently, until they don't. Behind this move sits a problem that cannot be solved with headlines, rate hikes, or press releases. A problem measured not in ounces alone, but in exposure, leverage, and trust. And one institution sits closer to the center of that problem than any other. JPMorgan, not because it is weak, not because it is careless, but because it is too deeply involved to simply step away. To understand why $67 matters, you have to forget the chart for a moment. Silver doesn't trade like stocks. It doesn't move like currencies, and it certainly doesn't behave like retail investors expect. Silver trades in layers. There is the visible market, the one people see on screens. The futures prices, the spot price, the headlines that say silver is up or down a few percentage points. Then there's the invisible market, the one that decides whether those prices mean anything at all. This is where contracts exist without metal, where volume can multiply without a single ounce changing hands, where leverage disguises scarcity. And for years, the system worked because trust held it together. Everyone believed that if silver was demanded, it would be delivered, that contracts represented something real, that paper could always become metal. But trust, once questioned, does not slowly decline. It snaps. When silver surged through levels that were supposed to trigger selling, not buying, something unusual became visible. The market wasn't reacting to speculation. It was reacting to stress. Stress doesn't show up in price alone. It shows up in behavior. Delivery delays, shrinking registered inventories, unusual spreads, quiet rule changes, and a sudden reluctance to talk about physical availability. None of these individually confirm a crisis. Together, they paint a picture that institutions recognize instantly, a system that works until it doesn't. JPMorgan knows the system better than anyone, not as an outsider, not as an observer, but as a structural pillar. For years, JPMorgan built one of the largest physical silver positions in the world while simultaneously dominating paper markets. This dual role gave it power, the ability to hedge, the ability to stabilize, the ability to absorb shocks that would destroy smaller players. But power in derivative-heavy markets comes with a cost, exposure, and exposure compounds quietly. The number being whispered now, $20 billion, is not a fine. It's not a loss already booked. It's a stress estimate, a scenario, a calculation of what happens when price movement collides with leverage, margin requirements, and delivery obligations simultaneously. This is where the nightmare begins. Because banks don't lose money when prices move against them. They lose control when markets stop behaving the way models expect. Silver at $67 is not dangerous because of the number itself. It's dangerous because of what it implies. It suggests that selling pressure, the kind that historically caps silver rallies, is no longer dominating the market. It suggests that buyers are not just trading momentum. They are demanding exposure that cannot be rolled forward indefinitely. In normal conditions, this wouldn't matter. Paper contracts would settle, positions would be netted, the system would breathe, but these are not normal conditions. Industrial demand for silver is no longer optional. Solar manufacturing, electronics, energy infrastructure. These sectors don't speculate, they consume, and consumption doesn't care about futures curves, it cares about delivery. When physical demand rises alongside investment demand, paper markets face an uncomfortable truth. They are only liquid as long as delivery is theoretical. Once delivery becomes real, everything changes. This is where JPMorgan's position becomes critical. As a dominant player, it is both a stabilizer and a point of failure. If it absorbs pressure, the market holds. If it reduces exposure, volatility accelerates. If it demands delivery, the illusion of abundance collapses. And this is why the idea of a trap exists. Not because silver is going to $100, but because the path toward that psychological level changes behavior long before it's reached. Retail investors see a target. Institutions see a threshold. At certain levels, risk models stop working. Margins rise. Collateral requirements adjust. Liquidity dries up in places where it's always been assumed. This is not panic, it's friction. And friction in leveraged systems creates heat. JPMorgan doesn't need silver to reach $100 to face a nightmare. It only needs silver to stay elevated long enough for confidence to erode. Because confidence is what allows positions to be rolled, extended, and rebalanced quietly. Once counterparties hesitate, even the strongest institutions feel pressure. This is why the market's silence is so revealing. There is no official narrative because no one wants to name the problem prematurely. If you call it a crisis, you accelerate it. If you ignore it, you risk being unprepared. So the system does what it always does in moments like this. It stalls. It stretches time. It hopes demand cools before structure breaks. But silver has a history of ignoring hope. Every major silver move in history began with disbelief. The idea that silver could break free from suppression has always sounded ridiculous, until it happened. And when it happened, it didn't reward patience. It punished complacency. This is not a prediction. It's a pattern. The real danger for JPMorgan and institutions like it is not price. It's exposure duration. The longer silver remains elevated, the harder it becomes to explain why paper supply still dwarfs physical reality. The harder it becomes to convince markets that delivery is irrelevant. And once that belief cracks, it doesn't heal. The trap isn't at $100. It's between 60 and 80, where behavior changes quietly, where sellers stop volunteering, where buyers stop trusting rollover promises, where every ounce suddenly matters. And this is where nightmares begin, not with collapse, but with questions. And once enough questions exist, answers stop mattering, because markets don't need certainty to break. They only need doubt. The illusion holding the silver market together has a name most people recognize, but very few understand. COMEX. To the outside world, it looks like a marketplace, transparent, regulated, liquid. To insiders, it functions more like a pressure valve. COMEX does not exist to move metal. It exists to manage expectations. Every day, enormous volumes of silver trade hands without a single ounce being touched. Contracts are opened, closed, rolled, netted, offset. This is not fraud. This is design. The system works because only a tiny fraction of participants ever demand delivery. Most settle in cash. Most never intend to see silver at all. But systems designed around assumptions are fragile. And the most dangerous assumption in the silver market is this, that delivery demand will always remain small enough to be ignored. The math exposes the weakness immediately. For every ounce of registered silver available for delivery, there are dozens, sometimes hundreds, of paper claims. Under normal conditions, this doesn't matter, because claims cancel each other out. But stress changes behavior. When prices move rapidly and persistently, participants stop thinking in averages. They think in contingencies. They ask uncomfortable questions. What if delivery is delayed? What if inventory classifications change? What if eligible silver doesn't become registered when needed? These questions are not conspiracy. They are operational. And JPMorgan understands them intimately, because JPMorgan is not just a participant. It is a warehouse, a custodian, a clearing entity. Its fingerprints are everywhere, in vaults and settlement processes and market structure. This gives JPMorgan influence, but influence cuts both ways. When silver prices rise sharply, two things happen simultaneously. Paper exposure grows more expensive to maintain, and physical silver becomes more valuable to hold. This creates a conflict inside institutions that straddle both worlds. Do you continue to support paper liquidity to maintain market stability? Or do you prioritize physical control to protect balance sheets? You cannot do both forever, and this is where the nightmare deepens. Because exiting a large position is not like closing a retail trade. You cannot simply sell without moving the market. You cannot quietly unwind when everyone is watching inventory levels. You cannot escape attention when delivery metrics are tightening. Any significant repositioning becomes a signal, and signals in fragile markets accelerate feedback loops. If JPMorgan reduces exposure too quickly, prices spike. If it maintains exposure too long, margin pressure grows. If it increases physical dominance, questions multiply. There's no clean exit. This is why the idea of just walk away is fantasy. Large institutions don't fail because of one bad bet. They fail because of structural entanglement. And silver is structural. The deeper problem lies in time. Silver doesn't need to explode upward to cause damage. It only needs to stay elevated. Time increases strain. Margin requirements adjust upward. Counterparties reassess risk. Liquidity providers become cautious. Each of these is manageable in isolation. Together, they create a tightening noose. This is where the psychological aspect of the so-called $100 narrative becomes relevant, not as a price target, but as a behavioral anchor. Markets don't move based on numbers alone. They move based on what people believe others will do. The idea of triple-digit silver changes conversations inside institutions. Risk committees meet more frequently. Hedging strategies are revised. Worst-case scenarios stop being dismissed. This is how traps work, not by forcing action, but by altering incentives. Retail participants see upside. Institutions see asymmetry. Upside can be limited. Downside in leverage systems cannot. This asymmetry is what institutions fear most, not volatility, but unbounded obligation. Silver's industrial role makes this worse. Unlike gold, silver is consumed. Once used, it doesn't return to vaults easily. It disperses into products, infrastructure, waste streams. This means supply tightness is not easily relieved by recycling alone. When investment demand collides with consumption demand, paper markets face reality. You cannot print ounces. This is why inventory movements matter more than price headlines. Quiet withdrawals, reclassifications, transfers between eligible and registered, these are not random. They are responses. Responses to pressure that does not show up on charts until it's too late. JPMorgan's size allows it to delay consequences longer than most, but size also magnifies exposure. When a dominant player adjusts, the market feels it immediately. This is why silence persists. No one wants to be first to acknowledge structural strain, because acknowledgement changes behavior, and behavior is what keeps the system functioning. The nightmare scenario is not default. It is disorder. Delayed deliveries, forced cash settlements, rule reinterpretations. None of these are dramatic on their own, but together they undermine confidence. And confidence is the currency of derivative markets. Once confidence erodes, participants stop playing the same game. They demand clarity. They demand security. They demand metal. This is when paper loses its advantage. This is why silver has always been dangerous. It sits at the intersection of finance and industry, too small to dominate headlines, too essential to be ignored, and now too tight to be controlled easily. The market does not need JPMorgan to fail. It only needs JPMorgan to hesitate. Hesitation reveals limits. Limits expose structure, and structure determines outcomes. This is why the current moment feels different to those watching closely, not because of a price number, but because the system is behaving defensively. Defensive systems do not collapse suddenly. They retreat, they ration, they delay. Until delay becomes impossible, what happens next does not require prophecy, only logic. If silver demand remains strong and physical availability tightens, paper leverage must adjust. Adjustment means volatility. Volatility forces decision-making. Decision-making reveals weakness. This is not inevitable, but it is possible. And markets price possibility long before certainty. The nightmare, then, is not silver at $100. It is silver refusing to go back to where the system is comfortable. Comfort is what allowed suppression narratives to survive. Discomfort is what ends them, and when suppression ends, repricing begins, not explosively, methodically, silently, until everyone notices at once. By then, it is never early, only obvious. And JPMorgan, like every institution embedded in this system, knows one truth better than anyone watching from the outside. You don't control silver when it moves. You manage the consequences, and consequences are rarely polite. Silver does not announce regime changes. It signals them, quietly. While attention remains fixed on inflation prints, interest rates, and stock indices, silver moves in the background, tightening, compressing, refusing to release pressure. This is why institutions fear it. Gold is visible. Gold is celebrated. Gold is discussed openly. Silver is tolerated until it isn't. The moment silver stops behaving like a side character, systems begin to reveal their seams, not cracks, seams, places where assumptions were stitched together with trust instead of metal. The most dangerous thing about the current market is not what is happening. It's what is no longer working. For years, each week silver remains elevated. It forces the system to answer a question it has avoided for years. Not how high can price go, but how long can this structure hold? Because leverage is patient only when price is obedient. When silver hovered in ranges, exposure could be carried indefinitely. Models worked. Margins were predictable. Confidence recycled itself. But elevated prices change the math. Not suddenly, gradually. And gradual pressure is the hardest to relieve. Every additional day above comfort levels increases collateral demand somewhere in the system. Every additional week forces risk desks to reassess assumptions they haven't questioned in decades. This is how stress propagates, not through panic, but through paperwork, through quiet internal memos, through revised risk weights, through conversations that never reach the public. And JPMorgan hears these conversations first, because JPMorgan is not reacting to silver. It is responding to everyone else reacting to silver. This is the distinction most observers miss. Large institutions don't move markets because they want to. They move markets because they must. Obligations accumulate invisibly until action becomes the only remaining option. The silver market is now at a point where action and inaction both carry cost. Action risks exposure. Inaction risks escalation. This is the definition of a trap. Not a trap set by conspirators, a trap created by structure. The idea that silver could ever be controlled indefinitely relied on one critical assumption: that confidence in settlement would always outweigh desire for possession. But possession is becoming relevant again, not emotionally, operationally. Industrial buyers don't hedge ideology, they hedge supply. When silver availability tightens, they don't speculate on charts. They secure material. This removes metal from circulation permanently. And every ounce removed from circulation increases the burden on paper markets to justify abundance they no longer physically support. This is why price behavior has changed. Rallies are not being sold with the same aggression. Dips are being absorbed faster. These are not retail signatures. They are institutional fingerprints. The system senses imbalance. And systems respond by conserving energy. Liquidity thins. Spreads widen subtly. Promises extend. None of this makes headlines, but it changes outcomes. The deeper issue for JPMorgan is not whether silver reaches a symbolic number. It's whether the market accepts symbolic assurances that paper represents metal. That delivery is optional. That settlement risk is negligible. These assurances only work when tested lightly. They fail when tested repeatedly. Silver is testing them now, not violently but persistently. And persistence is corrosive. The longer this persists, the more uncomfortable questions migrate upward. From trading desks to executives, from executives to regulators, from regulators to policy. And policy hates ambiguity, especially ambiguity tied to physical resources. This is where the narrative shifts from markets to systems. Silver does not threaten profits alone, it threatens perception. Perception that markets are deep, that liquidity is real, that price reflects availability. When perception breaks, repricing is not optional, it is compulsory. This is why the current moment feels restrained rather than explosive. The system is attempting to manage transition without acknowledging it. But transitions don't wait for permission. They happen when conditions align. The trap, then, is not for retail investors chasing upside. It is for structures that assumed compliance. Silver is no longer compliant. And non-compliance forces revelation. JPMorgan will not collapse because of silver. But silver will force JPMorgan and others to reveal how much control they actually have. And revelation is always disruptive. Because once the market sees limits, it tests them, relentlessly, not out of malice, out of opportunity. This is how financial history repeats itself. Not through villains, through incentives. Silver is incentivizing behavior the system was not designed to handle gracefully. That is the nightmare. Not a crash, not a headline. A slow, undeniable shift from confidence-based valuation to constraint-based reality. And once reality asserts itself, narratives become irrelevant. The market stops listening. It observes. And silver, unlike most assets, leaves very little room for interpretation once observation replaces belief. When this phase ends, however it ends, it will not be remembered for the price. It will be remembered for the realization that something long treated as manageable was never truly controlled, only deferred, and deferral always comes due, silently at first, then all at once.